Are you a business owner, but frankly unsure of your accounting and finance needs? Or are you just someone looking to learn more about accounting and finance? Well, if so, you're going to want to pay attention to this video and the new video series that I'll be launching in the coming weeks, talking about basic accounting, or what I call Accounting 101. Hi, my name is Chris Passmore, and I am your social media CPA. So as I mentioned, in the coming weeks, I'm going to be releasing several videos about accounting basics, Accounting 101, and this is to help you, maybe as a business owner or an accounting student, learn some of the fundamentals of accounting. So today we're going to start that off just highlighting 4 primary terms used in basic accounting. You need to understand the foundation before we start talking about more sophisticated accounting issues. So let's kick off. The first thing I want to explain to you today is the concept of a general ledger. And so what is that? What is a general ledger? How does that relate to your business? And are people still using that today? Well, a general ledger, or focus on ledger, is just your set of books and records capturing all the transactions for you or your business. One thing that you've probably heard of is QuickBooks, right? This is a software program that people use to track their expenses and income over the years. Well, QuickBooks is a form of a general ledger. It is just a software platform used to capture all of the transactions during a certain period of time. So a general ledger is just a method to capture all of the activity for your business. If you pay a bill for rent, you would record that transaction in your general ledger, and then you would have record of that payment made. So when you look back upon a period of time, maybe a year or a month, you can see what total expenses were paid or how much money you received in income. That goes into your general ledger, or a product such as QuickBooks or Xero would be a software version of a general ledger. So then the next term I want to talk to you today, the second term, is a journal entry. You're going to hear this all the time when speaking with accountants and CPAs, possibly your tax preparer, is we need to record a journal entry. Well, what is a journal entry? A journal entry is a way to record a transaction in your general ledger. It's simply memorializing an event in your books and records. It's called a journal entry because it's recorded in the old days on paper in a journal, and you're entering an activity, whether that is a outgoing check to pay for rent, like I mentioned a few minutes ago, or a receipt of payment from a customer. You record that event, you memorialize that transaction via journal entry, and you record each transaction generally in a separate journal entry. The third thing I want to talk about today is what's called the trial balance. If you have a business, you've probably heard about a balance sheet, an income statement, a cash flow statement, a statement of equity. But another common item used in accounting and finance is called a trial balance. So what is that? So a trial balance is a summary of all the accounts in your general ledger or in your QuickBooks file, and that would include both your balance sheet accounts and your income statement accounts. So as compared to a balance sheet, will only show you your assets, liabilities, and equity, and your income statement will only show your income and expenses. A trial balance will actually show you the balance of all the accounts in a single report, and it's typically shown in 2 columns, a debit and a credit, and we'll talk more about that in a minute. And that summarizes all the activity from your company, all the balances for a period of time in which you select. You can run a trial balance for a month, a week, or a year. That's up to you. You can set those parameters in your general ledger or your QuickBooks file, but that report will then summarize all of the activity for you in one place. Frankly, for me as an accountant, I do like a trial balance more than a balance sheet and an income statement, because I can see all the activity in a single report. I don't have to flip back and forth between 2 or 3 reports, and I find it very useful. And just a fun fact about the history of accounting. I know, it's accounting. Why is it called a trial balance? Well, back in the day, when these records were maintained in paper, you still had to make sure that the sum of your debits equaled the sum of your credits. They're meant to balance. They're meant to be the same amount when you add them up in total. So it was called a trial balance because it would be the first attempt by the bookkeeper to put all of the activity of the general ledger in a columnar format, debits and credits, to make sure they equaled zero, balanced, and then they know that the records are accurate. So that's your trial balance. So the last thing and the last key concept today I want to talk about is the definition of debits and credits. And this one's tricky, and for years I've had accounting professors try to explain to me the underlying concept of a debit and a credit. And one area and one key item that I kept getting confused about is in your bank, for example, in your checking account, if your bank debits your cash account, they're actually taking money away. But in the world of accounting, if you debit your cash, you're being given money. And I always struggled with that. And it wasn't until finally someone simplified the concept of debits and credits for me that I really felt better, and I want to share that tip with you today. So let's get back to the idea of the trial balance. You've got two columns, you've got a debit and a credit, and you need to make sure those balance. Well, the way I think about it, and the way I suggest you think about it, debit simply means left side, the first column. Credit simply means right side, the second column. And stop there. If you get too hung up on assets and if it's a natural debit or a natural credit, it's not something that you need to focus on. But if you simply think about left side and right side, debit is your left side, credit is your right side, your life will be much easier. And you can also think about it when you start to learn journal entries. When you write them out, you often have two offsetting amounts. You write one amount here, one amount here. Again, left side, right side, debits and credits. So that tip, that piece of advice for me years ago has saved me a tremendous amount of agony because I stopped trying to rationalize the underlying meaning. And once you learn left and right, everything else follows that. Your trial balance, your journal entries, your general ledger, your T accounts, which you'll learn soon in the future. Again, left and right. I think that has been a wonderful tip. So those are 4 introductory terms into the world of accounting. Hopefully that helps set the foundation as we start talking about other areas. We'll talk about assets and liabilities and equity and financial statements. And that's where I think we need to start, is in this foundation. Well, I hope you've found this information useful. Again, I have a whole series of videos coming about basic accounting so that you can run your business better, or if you're learning accounting, you can understand the concepts better. And I look forward to speaking with you again in my next video.